Hi there, tax accountants. I hope all is well, and I pray that as you're viewing this video, that you're in the best of health and spirit. This video will cover Chapter 8, Consolidated Tax Returns from Corporations, Partnerships, Estates, and Trusts, 48th edition. By the end of this chapter, you should be able to apply the fundamental concepts of consolidated tax returns, identify the sources of the rules for consolidated taxable income, list the major tax advantages and disadvantages of filing consolidated tax returns, identify corporations that are eligible to file on a consolidated basis, explain the compliance requirements for consolidated returns, compute a group's consolidated taxable income and appearance investment basis in a subsidiary, account for the intercompany transactions of a consolidated group, compute deductions and credits on a consolidated basis, compute limitations on the use of losses and credits of group members, and lastly, identify tax planning opportunities available to consolidated groups. So we start off with Unit 1. So to this point, our discussion has been centered on the computation of tax liability for standalone corporations. However, in this chapter, we're going to focus on groups of related corporations rather than single entities. So corporate conglomerates, they're present in every aspect of life. General Mills or General Foods, they'll likely own the local dairy or the bakery. The same thing in the oil and the insurance companies. They essentially are separate entities, but in the same juncture, they're a group of corporations that essentially work together. So some motivations for corporate groups to consolidate. There's some non-tax considerations that frequently provide stronger incentives for combining these corporations. So some of these non-tax considerations, they'll include the following: succession and estate planning goals to eventually transfer high growth assets that's in the corporation to future generations, protection of corporate brands by obscuring the ownership of subsidiaries that generate negative publicity. So, for example, if there's a subsidiary that could impose negative consequences from an environmental accident, making it easier to sell, transfer, or move a business line or operation with less disruption than if one corporation, let's say, had multiple business lines or operations in it. Isolating assets of a high-risk business segment in a subsidiary corporation that can obviously help to limit the liability exposure to the assets in other corporate affiliates. And if managers believe that the stock market doesn't accurately value the commingled assets, separate group members may be worth more. Obviously, if they maintain separate entities. So in addition to these non-tax considerations, there's some tax incentives as well that helps them to, or would encourage them rather, to combine the multiple corporations. So with that being said, they have rules in the Internal Revenue Code for consolidated returns. And these consolidated returns and the rules around them, they contain a lot of the tax incentives. So collectively, Congress and the Treasury Department, they appear to have two goals for the consolidated return rules. The first rule is to treat certain corporate groups as a single entity to the extent possible. So this potentially allows the group to use any available tax attributes that's optimal among its members. So if they have any net operating losses and things of that nature, then again, they'll get to use the tax attributes. And this includes losses of one member to shelter the income of another. Thus, the consolidated return, it gives corporate taxpayers an opportunity to manage their consolidated tax liability. So despite this opportunity to optimize consolidated tax liabilities, Congress and the Treasury Department, they essentially anticipated what they consider to be unacceptable tax planning opportunities. Because of course, if there is a rule that is in place, people are going to try to figure out how to take advantage of that. And as we know, Uncle Sam don't play that. So therefore, the Congress and the Treasury Department in the Internal Revenue Code, there are certain nuances around what is allowed and what is going to be disallowed. So with that being said, the second goal of these rules is to limit or eliminate any incentives to purchase another corporation to acquire its tax attributes like its net operating losses, capital losses, tax credits, essentially anything that a person would try to do, or corporations rather would try to do, just to ultimately pay less in taxes, because the net operating loss, the capital losses, and the tax credits, they have an effect on what the balance due, the tax liability to Uncle Sam would be. So again, consolidated return rules, they may be available to a taxpayer as a result of various business decisions, such as the following. Consolidated return, it may result from a merger, an acquisition, or another corporate combination. Group of business taxpayers may be restructured to comply with changes in regulatory requirements, meets the demand of a competitive environment, or gain economies of scale and operate more efficiently in a larger form. And taxpayers may be seeking to gain tax, financial reporting, and other economic advantages that are more readily available to corporate combinations. So Congress delegated most of its legislative authority for writing consolidated return rules to the U.S. Treasury Department. And as a result of that, the majority of rules that affect consolidated groups, it's found in Treasury regulations. So not necessarily the Internal Revenue Code itself, but the majority of the rules are found in the Treasury regulations, and the 11 pages of code provisions that deal with consolidated returns, they're strictly definitional in nature and they're broad in scope. So, and that's in contrast to more than 300 pages of related regulations that essentially dictate the computational as well as the compliance requirements of a consolidated group. So as you can see, working with consolidated returns, it can be I don't want to say difficult, but can be pretty complex, obviously, especially if it's broad in scope. You'll essentially need to know how to apply it based on the given situation. So we have what's called legislative regulations, and of this sort, they carry the full force and effect of law. So with these legislative regulations, the courts, they'll rarely support challenges to the content of these regulations. So consequently, taxpayers, they'll generally participate actively in the hearings process to try to influence the rules that are outlined in the final regulations. And the length and the detail of these regulations, they make the consolidated return rules, again, one of the most complex in the federal income tax law. So this brings us to Unit 2, assessing consolidated return status. So before electing to file a consolidated tax return, obviously there's some things that need to be considered. Individuals, corporations, they can't just make this decision all willy-nilly, for a lack of a better word, because again, just like with everything in life, there are advantages and there are disadvantages. So there are several tax advantages for group members whenever they file consolidated tax returns. So some of these potential advantages of filing consolidated returns include operating and capital loss carryovers of one group member that may be used to shelter the corresponding income of other group members. So if we're thinking of it from an individual perspective, right? Let's say someone has a W-2 job, they make $100,000 from the year, and in addition to that, they're also self-employed. This individual has, let's say, a $30,000 loss. So in such case, for that individual taxpayer, they're able to offset their $100,000 of W-2 employee income with the $30,000 loss. Combined, their income is effectively reduced to $70,000. So the same thing in essence as we are considering consolidated tax returns for corporations. Corporation A has $100,000 of income and Corporation B has $30,000, a $30,000 loss. Netted together, it's only $70,000 worth of income. So same thing, not just for the losses or operating loss, but also capital losses again. So if they, like sell capital assets, same thing, same concept. In addition, taxation of intercompany dividends may be eliminated. So as we know, one of the biggest disadvantages of the corporate structure is the fact that there's double taxation. The corporation pays taxes on the income. Then when they distribute dividends to shareholders, the shareholders, they report the dividend income on their tax return. We know we have the dividends received deduction and things of that nature. But again, one of the benefits is the taxation of intercompany dividends may be eliminated. Recognition of income from certain intercompany transactions can be deferred, gaining an advantage as to the time value of money. However, filing consolidated returns, it also imposes several tax advantages, or disadvantages rather. So before we get there, we'll just look at these last few advantages. Certain deductions and credits can be better utilized by using consolidated amounts in computing the pertinent limitations. Basis in stock that's owned in subsidiaries is increased as income is reported, and shareholdings of all group members can be used in meeting other statutory requirements. Now, as it relates to the disadvantages, the election is binding on all members for current and all subsequent year returns. So think of it like a marriage, right? I once heard of a story of a person who they got married, and then literally the day after, they no longer wanted to be married. Unfortunately, it just doesn't work like that, right? So same thing. The election, it may be terminated if the IRS consents to revoke it, or if membership in group changes and the new member is not included in the election. But obviously, it's not just a checkbox, right? There's a whole process that the corporations will need to go through, and the IRS will need to approve it. So something to keep in mind, losses on intercompany transactions, they are deferred. Using the parent's tax year creates a short tax year for subsidiaries. Basis in stock that's owned in subsidiaries, they're reduced if losses from the subsidiaries are reported. And there's additional reporting requirements that exist and additional administrative procedures that are going to be necessary. So hence, before these decisions are made to consolidate the tax returns, they want to make sure that this is something that they want to do. We move on to Unit 3, electing consolidated return status. So a corporation, they could join in a consolidated tax return if it meets 3 requirements. If it is a member of an affiliated group, it is not ineligible to file on a consolidated basis, and it meets the initial and the ongoing requirements. So we have this concept summary here. So again, the consolidated return election, we have the 3 requirements. Member of an affiliated group, is it eligible to file a consolidated return? And does it meet the compliance requirements? And there's forms 851, 1122. So some of the advantages and disadvantages, the taxable income computation allows a taxpayer to offset losses of one group member against the income of another. So simply stated, as mentioned earlier, think of it just like an individual taxation. The income can be offset by the loss. Deferred income recognition from certain intercompany sales. Again, deferred, that basically means postpone. It means to delay. So it doesn't mean that you never recognize the income. It simply means that you delay, you postpone recognizing the income. Group computation of credits and deductions, it can reduce overall taxes by fully utilizing the statutory floors and the ceilings. But some disadvantages, it derives group taxable income, and it may prevent the use of some members' losses or credits. It's a binding election with additional compliance requirements. Deferred loss recognition from certain intercompany sales, and certain code limitations are applied on a group basis. So again, something to really consider before the decision is made. We move on to affiliated group, which is the first requirement. So an affiliated group exists when one or more corporation owns at least 80% of the voting power and stock value of another corporation. So we can even think back to the dividends received deduction, right? So when we think about the dividends received deduction, if the corporation owns 20% or less, their dividends received deduction is 50%. If they own between 20% and 80%, they get to claim a 65% dividends received deduction. And then we know that if they own 80% or more, it was 100%. So again, we looked from the corporation from different aspects, but now we see essentially how everything ties in. If a corporation owns 80% of another corporation, the voting power and the stock value, then in such case, they are considered an affiliate group. So this requirement, it ensures that an identifiable parent corporation exists in the group. So there's the parent, who's the head, and then there are the subsidiaries. In addition, the group, it can include other corporations as long as one or more of the corporations in the group, they have to meet that 80% ownership test. So affiliated groups, they can include multiple tiers and chains of corporations as long as the group, again, they need to have an identifiable parent corporation, and that is one corporation that owns at least 80% of one of the other group members. The affiliated group members, they can choose to file tax returns in either two ways. First, they can file a separate tax return for each member of the group, and then they claim a 100% dividends received deduction for dividend payments that's passed along them, as just mentioned not too long ago. In addition, they can elect to file the consolidated income tax returns for two or more of the affiliates. But in such case, there's no 100% dividends received deduction that's allowed for payments among group members. However, the consolidated returns, they're going to disregard dividends to the other group members. So something to keep in mind. So we want to distinguish between an affiliated group versus a control group. So if there were no special rules, shareholders, they could essentially divide a single corporation into multiple corporations and duplicate tax preferences. But again, Uncle Sam ain't having that. So in such case, and an example, before 2018 corporate tax rates change, so as of right now, all corporations, they're taxed at a flat 21%. It doesn't matter if they make $1 million, $1 billion, 1,000, 100,000, doesn't matter. Everyone just pays a flat 21% due to the Tax Cuts and Jobs Act that was passed by President Trump. But before then, corporations were subjected to a progressive income tax rate similar to individuals. So basically, the more money you make, the more your tax liability, essentially, all right? But in such environment, splitting a larger corporation to smaller parts, that could reduce an aggregate tax liability significantly. Uncle Sam says, no, not happening, right? Now, obviously, it's going to be more difficult since it doesn't matter the income, everyone's a flat 21%, but under a progressive tax rate for corporations, in a case like that, that's where it would make the most sense to take advantage of that. So to combat that, Congress, they created what's called the controlled group rules to protect against this behavior. So these entities they're related through common ownership, such as having common shareholders. Controlled groups, they include parent subsidiary groups as well as brother sister groups. An affiliated group is similar, but it's not identical to a parent subsidiary control group. So a parent subsidiary control group, that exists when one corporation owns at least 80% of the voting power or stock value of another corporation on the last day of the tax year. So that's one of the key things, the last day of the tax year. So members of control groups, they're required to share a number of tax benefits, included the $250,000 accumulated earnings credit. They must defer recognition of a realized loss on intercompany sales until the sale is made at a gain to a non-group member. They must recognize as ordinary income gain on the sale of depreciable property that takes place between controlled group members. So again, the parent subsidiary control group exists one corporation owns at least 80% of the voting power or stock value of another corporation on the last day of the year. They can have multiple tiers of subsidiaries and chains of ownership, but they must have an identifiable parent. So the Internal Revenue Code lists a number of corporations that are not allowed to use a consolidated return to report their taxable income. So in such case, if you are a part of that list, you cannot file a consolidated tax return, unfortunately. So thus, these corporations, they can't be used to meet the stock ownership tests, and their taxable income cannot be included in a tax return. So some of the most frequently encountered entities that are considered ineligible includes any corporations that are established outside of the U.S. or in a U.S. possession, any tax-exempt corporations, insurance companies, partnerships, trusts, estates, limited liability entities, or other non-corporate entities. So these corporations, they cannot, again, be used to meet the stock ownership test, and their income, again, can't be included in the consolidated return. So are these eligible groups? Again, these are some key things to keep in mind. So we have this example here, and in the ownership structure on the left figure below, we see Phillips, we see Reyes, we see Todd Corporation, and we see Valiant form. So they essentially they form an affiliated group. Phillips is the parent. Under the stock ownership rules, it shows us that they own 100% of this stock. Valiant, which is a life insurance company, they can't combine their income, however, in a consolidated return. So therefore, the consolidated election, it's only going to be available to Philip, to Reyes, and to Todd. In the structure on the right, however, we have Philip, we have Reyes, and we have Todd. They form what's called an affiliated group. So in all of them, they can be included in a properly executed consolidated return. As we see, Phillips is essentially the parent, meeting the 80% requirement through both direct and indirect ownership. So therefore, Reyes and Todd, essentially, they'll form their own brother and sister group below Phillips, but that has no effect on a consolidated tax return. So again, once these corporations, they're decided to come together, they need to determine, are we a controlled group or are we an affiliated group? Because obviously that will have an impact, and depending on the type of corporation, as we see, there's a list of those that Uncle Sam says, you cannot file a consolidated tax return. So all of these things need to be factored in. So we move on to the compliance requirements. Again, when there's a consolidated tax return, the complexity is greater in addition to the compliance burden. So a consolidated group, they can include an eligible entity's income if the entity and group meet several compliance requirements. The first is the initial consolidated return. They must meet the following requirements. First and foremost, Form 1120 should include income of all members of a consolidated group. Form 1122 should be attached to the first consolidated tax return for each of the subsidiaries included in the group. This represents consent by all entities to be included in the consolidated group. So this is similar to an S election. If a LLC or a corporation decides, hey, we want to be taxed as an S corporation, on that form 2553, all shareholders, all members who are going to become shareholders, their names and signatures must be on that form. The election, it must be made no later than the extended due date of the parent's return for the year. But there's a caveat, only in the case of an inadvertent error. So not like, okay, we're tax planning at the end of the year, let's do this. No, like it literally needs to be like, oh man, we didn't know this was the deadline. So obviously there's like, cause and things of that nature. Letters can be attached to the return to kind of explain if the deadline is missed. But again, it should not be an intentional delay of not making the election. So only in the case of an inadvertent error can the election to consolidate be rescinded once this extended due date passes. Subsequent consolidated returns. So every year, the consolidated tax return, it must include Form 851. And Form 851 is the affiliations schedule. This report, it identifies all of the corporations in the electing group. It summarizes the pertinent shareholdings and the stock ownership changes that occurred during the tax year. In addition, it lists the estimated tax payments that were made by the group members for the year. Next, we have the return due date. So generally, consolidated tax returns, same thing like individuals and corporations. Those are considered the tax-paying entities in the U.S. federal income tax system. And those returns are due on the 15th day of the 4th month following the close of the group's tax year. So simply stated, April 15th each year. And if April 15th falls on a holiday or if it falls on a weekend, then it's the following business day. There's a 6-month extension to file the return that can be obtained by executing Form 7004. So same thing like if you were filing a single entity tax return. Liability for the tax year. So an electing group that computes its regular tax liability by applying the C corporation tax rate to consolidate taxable income for the year. So again, now it's much easier. Before President Trump made the Tax Cuts and Jobs Act, well, not made it, but he basically signed it into law and went through Congress and the House and everything. But essentially before that came into play, this was a bit more difficult because, again, it's on a progressive tax rate. So if Corporation A made $100,000 net income, Corporation A had $1 billion, the tax liability was a bit more skewed. But now it's a bit easier because, again, everyone is at a flat 21%. Makes it a bit easier. So group members, they are jointly and severally liable for the entire consolidated income tax liability. So just like as it relates to individual income taxation, when persons file a married filing joint tax return, both spouses, they are jointly and severally liable. So something to keep in mind. This rule, it also applies to interest and penalties imposed as a result of an audit, as well as any tax liability. So furthermore, the IRS, they are not bound to follow internal agreements among the group members in apportioning the liability if the effect is to reduce the group's liability. All right. So that would be like, this is actually interesting. I wonder if sometimes people, they get married and they sign a prenup, and let's say in the prenup it says spouse A is not going to be responsible for spouse B's tax liability. I am almost positive that if they file a tax return and they file it as married filing joint, that prenup is basically, well, that part of the prenup is going to be null and void. Uncle Sam does not care, right? You basically filed this return and it says you are jointly and severally liable. If you file it as married filing joint, same thing. In such case, the rules, they're going to apply to interest, penalties, and liabilities. Therefore, all group members of this consolidated tax return, they are liable. Let's see. So federal corporate income tax liabilities, they're apportioned equally among the group members unless all members consent to some other method through an annual election. So this would be like tax sharing, as we see here. And a commonly used tax sharing agreement is the relative taxable and relative tax liability method. So federal corporate income tax liabilities, they can be, again, apportioned equally among the group members. And Treasury regulations, they decided to sanction 2 methods for sharing the consolidated tax liability. So Uncle Sam isn't so bad, right? This is an option. So obviously, as corporations, they are deciding we want to come together and consolidate. These are some things for them to consider and to put in place beforehand. So we have the relative taxable income and we have the relative tax liability method. So under the relative taxable income method, the group, they're going to allocate the consolidated tax liability among the members based on their relative amounts of separate taxable income. So, I mean, pretty straightforward for the most part. And when the relative tax liability method is used, the group allocates the consolidated tax liability based on the relative hypothetical separate tax liabilities of the members. And again, because corporations now have a flat 21% tax rate, this is far easier to determine. As it relates to the tax accounting periods and methods, the tax year of the parent must be used by all the members. The short year return, it may be required for the first year a subsidiary is included in the consolidated tax return, and accounting methods in place at the date of the election, those will continue to be used. And as we know, we're just, covering the federal consolidated tax return. Some states, they handle it different. So a federal election to form a consolidated return, it is not binding for state income tax purposes. Just like an S corporation tax return, you'll file the form 2553 with the federal, but that does not mean that you are an S corporation at the state level. You also need to file a form with the state to ensure that they recognize you as an S corporation as well. Same thing with the consolidated returns. If it's recognized at the federal level, does not mean that it's also recognized at the state level. So some states, they allow only separate filing return, and others, they may define the members of an electing group or their tax income differently in comparison to the federal rule. So many states, they'll limit the deductions for net operating losses, passive activity losses, and the like to only in-state operations. So obviously, when you're dealing with multi-state taxation, it can become far more complex. This brings us to Unit 4, stock basis of the subsidiary. So, like most taxpayers that purchase an asset, an acquiring parent corporation, they'll record a subsidiary stock basis on its tax balance sheet that's equivalent to the cost. However, unlike most taxpayers, the acquiring parent corporation, they're going to need to adjust their basis in the subsidiary stock in a procedure that's similar to the financial accounting equity method. So these adjustments, they help to prevent double taxation of gain or deduction of loss if the parent later decides to sell the subsidiary shares. The adjustments, they're recorded on the last day of the consolidated return year or on the earlier date of the disposal of the shares. So some positive adjustments to the basis include the allocable share of consolidated taxable income for the year, any allocable share of consolidated operating or capital loss of subsidiary that they could not utilize the loss through the carryback to a prior period. Some negative adjustments, some decreases to the basis of subsidiary. If there's allocable share of consolidated taxable loss for the year, if there's allocable share of any carryover operating or capital losses that are deducted on a consolidated return and they have not previously reduced stock, and any dividends that's paid by the subsidiary to the parent out of earnings and profits. So whenever there's accumulated post-acquisition negative adjustments to the stock basis of the subsidiary and they exceed the acquisition price plus the prior positive adjustments, in such case, there's an excess loss account that's created. So this approach, it allows the consolidated return to recognize the losses of a subsidiary in the current year. The group is not subjected to a basis limitation on the loss deduction. If the parent decides to deconsolidate, they redeem the subsidiary, or let's say they sell it to a non-group member, then the selling parent corporation, in such case, they're going to need to increase their recognized gain on the transaction by the amount of the excess loss amount. And in the event that it's sold to the third party, then the excess loss account is going to be recognized as a capital gain. If there's a chain of more than one tier of subsidiaries, then the computation of the stock basis in the lowest level subsidiary starts. and they'll proceed up to the ownership structure to the parent holdings. There's no such concept as consolidated E&P in the federal income tax law. So rather what happens, each entity, they're going to need to account for their own share of consolidated taxable income on an annual basis. They'll immediately recognize within their earnings and profits any gain or loss on intercompany transactions, and they would reduce the earnings and profits by an allocable share of the consolidated tax liability. This brings us to Unit 5, consolidated taxable income. So we want to recall that the overall goal in preparing a consolidated tax return is essentially to combine the individual corporate tax returns in a way that'll reflect their aggregated status. So, that's the overall goal. Therefore, whenever an affiliated group, they compute their taxable income from a year, they don't simply just add together the separate taxable income amounts of its members. Instead, the group, they need to remove two types of transactions from the members' tax returns when they consolidate. So as mentioned, it can get a little more complex, right? So these transactions, then they'll receive special treatment either from a special rule or to better reflect the overall goal of taxing a consolidated group as if it were one corporation. From there, the group, they'll recombine the special items with the remaining items of the members' taxable income in order to obtain the group's consolidated taxable income for the year. So we have what's called the sequential approach. Again, taxable income computed separately for each member of the group items, and then there's the intercompany items. They're removed from the aggregate separate taxable income amounts, receive special treatment, and then the remaining separate incomes, they're combined with group and intercompany items, resulting in that consolidated taxable income. So this computational procedure, it allows several transactions to be accounted for on a consolidated basis. So an example of this would be charitable contributions, capital gains and losses. Any gains and losses from certain intercompany transactions, they're going to be deferred until a later tax year. And there's a few intercompany transactions that are removed from the taxable income calculation altogether, and they will never appear in a consolidated return. And an example of that are dividend payments. So here we have this exhibit, and it illustrates how to construct the consolidated taxable income using the sequential approach. As we move on to the intercompany transactions, so most intercompany transactions, they'll remain in the members' separate taxable income. So dealing with intercompany transactions and events, obviously, it can get, pretty complex, but the regulations, they base their treatment on logical principles that are helped to result in three different types of intercompany transactions. So services provided by one member to another member. Services provider, they'll recognize as the income. The service purchaser recognizes a deductible expense. And the net result obviously is going to be zero to the consolidated taxable income. So basically, money coming in, money going out, nets out to zero. When members involved in an intercompany transaction use different accounting methods, in such case, the payer's deduction for intercompany expenditure is going to be deferred until the year in which the recipient recognizes the related gross income. So again, this is basically a temporary difference, right? Let's say one corporation, they are using the accrual basis method of accounting, and another corporation, they're using the cash basis method of accounting. There's a difference. It's a temporary difference. It's eventually going to be recognized. It's just a difference in timing. Next, we have dividends that are received from other group members. It's eliminated from the recipient's separate taxable income. There's no dividends received deduction allowed. If the dividend, however, is a non-cash asset, in such case, the payer member realizes gain but defers recognition until the asset leaves the group. The eliminated dividend amount is going to be equivalent to the fair market value of the asset that has been received. Next, we move on to the matching rule. So when we think about the matching rule, again, this is going right back to the basics of financial accounting. Same thing. So with the matching rule, this requires group members to defer gain or loss on the sale of assets within the group until the group that sells the asset, they're selling it to a third party. So in most cases, obviously, the matching rule is going to be deemed as advantageous to the group whenever the intercompany sale produces gains, but it's going to be disadvantageous whenever they have a loss. So certain intercompany transactions, in addition, that receive the deferral treatment, this applies to the following transactions among group members: the sale of assets, as well as the performance of services. The entire deferred gain or loss, it's included in the consolidated taxable income one. The asset is transferred outside the group. So again, it's sold to a non-group member. The transfer of property, it leaves the group, or the consolidated election is terminated. So the tax law imposes limits and other restrictions on several income and deduction items. So in keeping with the goal of treating a consolidated group as one combined taxpayer, the group, they'll apply the limits and the other rules using consolidated taxable income rather than on a separate company income. So specifically, the group, they'll need to compute the following items using combined group numbers after removing any appropriate intercompany transactions. So this includes any net capital gain or loss, Section 1231 gain or loss, any 163J business interest expense limitation, the various tax credits and recapture amounts, casualty, theft, gain or loss, charitable contributions, dividends received, deductions, net operating losses. In several items that's computed on a consolidated basis, they'll need to remove all of these items from the member's separate taxable income, and from there, they'll use the consolidated taxable income to the point to determine the statutory limitations for the group basis gains, losses, income, and deductions. With the member net operating losses, so these NOL, so often the election to file a consolidated return, it's partly motivated by the parent's desire to use the favorable tax attributes of a subsidiary corporation, especially a net operating loss, because obviously if there's a net operating loss, it's going to offset the tax or reduce rather the tax liability, because the net operating loss offsets the taxable income. So the usual corporate provisions for net operating losses, they're available for consolidated losses for tax years prior to 2018. They'll carry it back 2 years, carry it forward 20 years, and the parent, they could elect to forego to carry back deductions for the group, but any losses that arise after 2017, they cannot be carried backwards, only forward. And the losses, they carry forward indefinitely until they're fully utilized. And losses, they cannot reduce taxable income that by more than 80% in the year that the loss is applied. So in such case, there's special rules that are going to apply for any NOLs that are incurred between 2018 to 2020 under the Tax Cuts and Jobs Act, the new rules. So in computing the consolidated NOL, they'll remove the consolidated charitable contributions and capital gain or loss from taxable income. Obviously, these items, they'll have their own carryover periods and rules. Some complications, obviously, they're going to arise whenever group members, they enter or they depart from the consolidated group. Any members' NOLs, they're either incurred as a separate return year and deducted in a consolidated return year, or vice versa. So there's several restrictions that's going to limit the availability of such NOL deductions. So in the event that, let's say, members of a consolidated group, they'll change over time, the consolidated NOL, it needs to be apportioned to the group members using the following formula. So we have the members' separate NOLs in our numerator divided by the members' aggregate, the total net operating losses. We multiply it by the consolidated net operating loss. And from there, we allocate to each member of the consolidated group what their apportioned net operating loss would be. In a year when a group member files a separate return, only the apportioned net operating loss is going to be carried over. And whenever a member leaves the group, any apportioned share of unused loss carryforwards, they'll be used in the subsequent separate returns. And any separate return limitation year, so that's what's called SRLY. So another complication arises whenever a corporation decides to enter or they decide to leave a consolidated group. So to what extent should the law allow a corporation to use a loss from a year before it entered the group when it was a separate return year against any income that it entered into the group and vice versa? So in such case, as we know, Uncle Sam ain't having that, right? Because some corporations, what they will probably do is that, let's say, especially, let's think of it like when COVID took place, right? Obviously, there's a lot of corporations that took losses. If there wasn't these special rules that were put in place, bigger corporations, they would decide to consolidate with corporations that had a loss to absorb the losses. But again, Uncle Sam ain't having that. So in such case, Congress, they've been extremely reluctant to allow a consolidated group to use losses from a year when a group member was not a part of the group. So in particular, Congress, they want to restrict the incentive for a profitable corporation to purchase an unprofitable corporation to harvest its tax losses and credits. So accordingly, the Internal Revenue Code, it includes the restrictions that discourage buying loss firms to use their losses and credits to reduce another corporation's tax payments. And the reason I'm laughing is because, again, that's why a lot of the rules are in the Internal Revenue Code, because Uncle Sam is pretty much up on game for the most part. Or I feel what happens often is that there are corporations or individuals that take advantage, and then once they get a whiff of it, it is disallowed because there's now a code, there's now a rule in the tax law that disallows or prevents what the individual or the taxpayer, whether it's an individual or a business, what they're trying to do. So this brings us to the end of this chapter. Now that the lesson has ended, you should have learned to apply the fundamental concepts of consolidated tax returns, identify the sources of the rules for consolidated taxable income, list the major advantages and disadvantages of filing consolidated tax returns, identify corporations that are eligible to file on a consolidated basis, explain the compliance requirements for consolidated returns, compute a group's consolidated taxable income and appearance investment basis in a subsidiary, account for the intercompany transactions of a consolidated group, derive deductions and credits on a consolidated basis, identify limitations on the use of losses and credits of group members derived in separate return years, and lastly, identify tax planning opportunities available to consolidated groups.